Hello and welcome to the second of two videos which make up this quarter's investment update. In the first video we looked at what's been happening in the economy and in markets, particularly focusing on what's been happening with Donald Trump and his trade tariffs. In this video we're going to look at how that's affected portfolios and how we're positioning them for this current outlook. The key message at the moment is that things are very uncertain because we just don't know what's going to happen with those tariffs. Now these could push up US inflation and slow economic growth if the tariffs are too high. Stock markets fell sharply earlier this year but have now largely recovered. But as we discussed in the last video, long-dated bonds have fallen in price as people are beginning to worry about long-term government debt. In addition, the US dollar has continued to fall, indicating perhaps a loss of confidence in the US. Now, all of this has had an impact on the portfolios in terms of volatility, but I do think it's important to note that all of them are up so far this year. And in fact, the core portfolios of kind of cautious, balanced and adventurous are all up in the region of 3% or so. And there's plenty of performance information in the written version of the report. And all of the portfolios bounced back strongly from the falls in April, and they're all roughly in the region of about 6% up over 12 months. So the short term remains uncertain, even though returns have been positive. But in investing, as always, it's the long term which is important. And this table shows the returns of our core portfolios over the last 10 years. Now, as you can see, over the last decade, the portfolios are up between 46% and 73% in total. Now perhaps that's a bit surprising when you think of all of the things that have happened over the last decade. Brexit, Trump, COVID, cost of living crisis. But as usual, I think to judge our performance, we should compare ourselves to other investors who are trying to do something similar to us. For example, we could compare our returns to the typical mixed investment fund, which has between 20 and 60% in the stock market. And those have returned about 46% over the same time frame. So that's about the same as cautious, but cautious has been a lot less volatile. But it's well below what balanced and adventurous have done. Alternatively, we can look at the balanced portfolios run by wealth managers and private banks, and those have returned 43% over the same time frame. Now, of course, the key objective of all the portfolios is to beat inflation over the long term. And despite that very high inflation we had in the last couple of years, all of the portfolios have been able to do that. Now, not by as wide a margin as perhaps we'd normally expect, but they've still grown in real terms. And the same cannot be said for leaving your money in the bank. So had you done so, and had you got interest in line with base rate, your return would have been less than inflation, which means you'd have lost money in real terms. So we think this shows just how important it is to invest. If you want your money to grow in real terms, we think investment is definitely the way to go. And hopefully you can see from that we've done a pretty good job compared to some of the other managers out there. So now let's have a look at how portfolios are positioned given that uncertain outlook that I mentioned. This table is based on the balanced portfolio, and this shows how things have changed in the last year. And what you can see from this is we've reduced fixed interest exposure along with real assets compared to this time last year, and we've topped up alternatives and defined returns. Our equity exposure in the balanced portfolio is about the same as this time last year. Now, fixed interest has done reasonably well, providing a nice slow and steady 6.5% or so over the 12 months. Now, in particular, our corporate bond funds have done well, but government bonds like gilts and US Treasuries have only returned fairly low returns. And as we discussed in the last video, government bonds have struggled of late, partly because interest rates haven't been cut as much as people thought they might be, and partly because governments have been increasing the amount of their borrowing, so there's a greater supply of government bonds for a similar level of demand, and that impacts the price. So in portfolios, we generally prefer corporate bonds to government bonds, and in particular, we really like short-dated bonds. And this chart shows why. So the blue line on here is our short-dated bond funds over the last year. And we're comparing this to the typical corporate bond fund in red and the gilt index in green. Now, as you can see, the short-dated funds have outperformed. They've returned over 7%, And what's more, you can see they've been a lot less volatile than the other types of bonds. You can see the line is much straighter. Now we're still getting a good yield from these funds in the region of about 7%. Now a lot of this is lending money to companies, and that has some risk, and actually some of the companies that we're lending to do have lower credit ratings. But by only lending the money over a fairly short period, a maximum of maybe 2 or 3 years at most, and often a lot shorter than that, that really reduces that risk. So we think short-dated bonds, short-dated corporate bonds, have a pretty good potential return for a relatively low level of risk. Now, over the 12 months, you can see from the table that we've also reduced real assets, and that was by us essentially selling out of real estate or property, which has proved really sensitive to interest rates. So instead, what we've done, whilst we've reduced exposure to real assets, we've kept some, but we've switched that into a low-cost utilities fund. Now, hopefully this could hedge against higher inflation, because it can actually do well if energy prices rise, for example. And hopefully it would also prove resilient if the economy does slow. As well as that, we increased alternatives. Now, these are essentially low-risk, absolute return strategies, which are very lowly correlated to both stock markets and bond markets. And at this point of time, with the kind of uncertainty around, we think that diversification is really useful. And finally, we added to defined returns. Now, essentially, these are structured products linked to the stock market and linked to an index like the FTSE 100 or the S&P 500. In essence, should these markets be the same or higher than they were when the products were set up over the next 5 years, then the product should give us a double-digit return. Current estimate is in the region of maybe about 11%. And what's more, they do so with that greater degree of certainty than investing in the stock market, because as I said, they only need the stock markets to go sideways really, and in fact they can even go down a little bit for some of the products, and we can still get that level of return. So we think the kind of risk-return trade-off again looks pretty favourable. Now this chart shows how these defined returns products have performed over the last 5 years. So they're shown in blue. The FTSE 100 is in green and the S&P 500 is in red. Now you can see defined returns have done really well, so they've beaten the FTSE over the 5 years, but the returns haven't been as strong as the S&P 500 because that's absolutely flown over that time. But once more, you can see that the line is much straighter, so that means defined returns has been much less volatile than the main stock markets. So this illustrates both the benefit of the defined returns, but also what we see as one of the main risks. In essence, that if markets go up strongly, then they might underperform because the returns are capped. But we think in the current environment, the reduced uncertainty is pretty valuable. In essence, looking forward, we think there are some assets in the portfolio that should provide some pretty decent returns, almost despite what's happening with tariffs and what's happening with Donald Trump. Things like defined returns, things like short-dated bonds. Now, obviously those things with Trump and the volatility we've seen are concerning when they happen, but they're very much short-dated concerns. And as we always say, investing is about the long term, and over the long term, it's the fundamentals of the asset classes that drive the returns. And at the moment, we still see some pretty good fundamentals in certain asset classes. Slightly wary about the stock market where it's a little bit expensive. We could see a pullback in the short term, but by doing things like defined returns, like short-dated bonds, that can kind of offset some of that uncertainty and hopefully provide some good returns going forward. So we hope you found these updates useful, and as usual, we'll see you again next time.